Hey everybody, welcome to another segment of Accounting Imbalances How Do I series. In this segment, we get to continue our discussion of how do I record inventory using dollar value LIFO. And we had started to work on this particular problem for Cougar Company. And Cougar Company was trying to use dollar value LIFO and needed to figure out what the value would be in 2020. Now, we started last time by looking at 2017 and 2018, and now we need to move on and finish our example by looking at 2019 and 2020 so we can get that final value. Now, this seems like a really long process because we're doing all of the years at once. But keep in mind, in reality, an accountant or an accounting team would only be looking at one particular year. We'd calculate our values if we purchased all of the inventory still on our shelves at the end of this year, and then we calculate a price index that relates this year's prices to our base year's prices. And it's that price index and that calculation that's the real key to dollar value LIFO. You see, part of the problem with any kind of calculations over time is that we're looking at not only changes in the decisions we made and the inventory we purchased, but also at the changes in the economy through inflation. And what we're doing with this dollar value LIFO method is we're pulling inflation out of the picture while we compare the size of our inventory from one year to the next. And once we know the relative size, not worrying about inflation or actual costs, but just how big was this layer, how big was this layer, how big is the next layer, then I get an actual signal of what the company has done each year in regards to inventory. And once I know that, then I can reinflate back to what I really did spend. And again, it looks really long when you try to do all of that at once for multiple years. But we're really only doing 1 year at a time. Let's show you what I mean by looking at 2019. So in 2018, we figured out our ending inventory at base year was $374,000. $367,000 that we would have purchased back in 2017, and $7,038 that we purchased in 2018. The $367,000 we bought in our base year, which means it really did cost us $367,000. The $7,038 we actually purchased in 2018, not the base year. So it really would have cost us $73.20. And then I add those up to get the $374,320. In 2019, I end the year with $385,000 worth of inventory. And our price index was 107. Now we put the percent in there because even though we say 107, it's really 107%. That's our inflation from 2017 when we started to now in 2019 where we're doing our calculations. Essentially what we're saying is because of inflation, what we would have paid $1 for in 2017, we'll pay $1.07 for now in 2019. Now that I have those numbers in there, I'm going to divide the 385 by that 107, and I see that to buy that $385,000 worth of inventory in 2017 when I started, it would have cost me $359,813. So let's come down to our table. And again, I am just adding on in my new table to the values that I already have calculated. And I find in this case, $359 is less than what I've had in the past. I've shrunk my inventory. In other words, I'm using up what's on the shelves instead of buying more. So the first thing I would do under LIFO is I would sell off the inventory from 2018. So this is gone. And then I would have started selling inventory from that first year, 2017. So I'm actually going to replace this with that same $359,813. And that's going to change my inventory at estimated cost to be $359,813, and that becomes my ending inventory. Why? Because I don't have anything left from 2018. I sold it, and I didn't have anything left from 2019. I sold it too. I even dipped into my 2017 inventory and sold some of it from $367 down to $359. Hopefully that makes sense. Now let's take a look at what happens in the next year when I build my inventory back up again. In 2020, I have $420,000 sitting on my shelves at 2020 values. That's what I would have paid for it if I bought all of it at the end of 2020. Now I look at my price index. It hasn't gone up much since 2019, but it has gone up 1%. Again, this means that if I had purchased that $420,000 worth of inventory in 2017 when I started doing dollar value LIFO, it would have cost me $388,889. So now I come down to my dollar value LIFO table. I put in my 2020 and my 388,889, and I look at my layers. Now, a lot of people look at that and they say, oh great, let's put back in the 367, let's put in the 7,000 again, but you can't do that. Once you've sold inventory, it's gone. You can't recover it ever. So all I can do is say, all right, I have $359,813 left from what I had originally purchased in 2017. What have I now added in 2020? Because all the 2018 and all the 2019 inventory has been sold. So as I calculate my layers, I'm going to take that 38,889 minus the 359,813 and assume that I have purchased in 2020 $29,076 worth of inventory. That's at base year prices. Let's get it back to what I really did spend. I take that $29,076, I multiply by the 108, and I assume that that I would have paid $359,813 for inventory left on my shelves that I purchased back in 2017 and a new $31,402 on my shelves that I purchased in 2020. And now, one last calculation, and I can see that I show on my balance sheet $391,215 of inventory. And that's my answer. And that's how I do dollar value LIFO. Again, it seems really complicated when you're trying to do multiple years at once. But if you just look at the time it took us to do 1 year, this is a pretty fast calculation, especially with computers and databases now that will calculate our price indices and our ending inventory at current year prices so fast and easy. Hopefully all of that makes sense and you're ready to go doing dollar value LIFO problems moving forward. And of course, we'll have more exciting topics in our How Do I series coming up. We'll see you then. Thanks.